NIQ Global Intelligence just delivered a massive Q2 2026 beat across the board,
Oh, sure.
completely crushing consensus estimates.
Yeah, it was a blowout.
Right. I mean, adjusted EPS came in at 27 cents, which just blew past the Wall Street estimate of 20 to 21 cents.
Totally.
And revenue hit $1.124 billion. So that edged past forecasts and was up 8% year over year.
Which is huge.
Yeah. Plus, management raised their full-year 2026 adjusted EPS guidance significantly, bumping it up to a range of $1.08 to $1.12. They raised revenue growth guidance to over 7%, and they lifted levered free cash flow guidance to that $250 million neighborhood.
And, I mean, the market just aggressively repriced the stock on that news.
Oh, absolutely.
It jumped, what, like 15.58% in after-hours trading initially?
Yep.
And then it ended up surging 42% on the following day to close at $16.58. That is the kind of violent upward re-rating you really only see when a management team, fundamentally alters the forward narrative.
Exactly. Which brings us to the mission of this deep dive. Because with a headline shocker like that out of the way, we really need to unpack exactly where this top-line outperformance actually came from.
Right. We have to look at the regions and the segments.
Yeah, so for you listening, we're going to break down the anatomy of this revenue engine to see if this 42% pop is actually justified.
Right, because top-line growth of 8% is great, but the organic constant currency, the OCC growth of 5.8% is the metric that proves this wasn't just, some accounting mirage driven by exchange rates.
Exactly.
And this is their 5th consecutive quarter of beating consensus. When you break down that OCC growth by geography, you see a business that's really just firing on all cylinders.
Well, the Americas definitely led the charge, right? I mean, they posted 8.3% OCC growth with an adjusted EBITDA margin of 31.4%.
Yeah, that's a massive cash cow.
Totally. And EMEI put up 4.9% OCC growth with an even bigger 35.3% margin. But, those are the mature markets. The real inflection point here, at least for me, is APAC.
Oh, absolutely. The Asia-Pacific region has historically just been this complex puzzle that NIQ couldn't quite solve.
Yeah, it's been like a heavy anchor.
Right. But this quarter, APAC grew 1.9% on an OCC basis with a 19.8% margin. So it finally returned to year-over-year growth and showed this really meaningful sequential improvement from Q1.
Let's unpack that for a second, because since their 2025 IPO, APAC has just been dragging on their overall metrics.
Yeah, it has.
Like, it's been this massive anchor, and now it's finally been pulled up to act as a tailwind. But how much of this APAC turnaround is actually organic versus the contribution of their Yimian acquisition?
That is the million-dollar question.
Right, because buying that e-commerce data business in China and Southeast Asia obviously boosts top-line numbers artificially.
It does, but that structural difficulty over there is precisely why they bought Yimian. Buying an established specialist gave them the localized architecture they really needed.
Sure, but you buy a company, your revenues go up. That's just addition.
True. But this is exactly where that 1.9% OCC metric comes in. Because organic constant currency tries to strip out the immediate revenue bump of recent acquisitions.
Okay, got it.
So finding a positive 1.9% there actually indicates that the core legacy business in APAC has finally stabilized.
Wow, okay.
Yeah, it's not just masking a declining core.
That makes sense. And we see that stabilization translating to their core products globally, too. Intelligence OCC grew 5.7%. And activation OCC grew 6.1%.
Yeah, both accelerated.
Right. And we hit this massive milestone. Annualized intelligence subscription revenue has now officially eclipsed $3 billion.
Which is just a crazy number. Crossing $3 billion in recurring subscription revenue fundamentally changes how the market values them.
Because it's sticky.
Exactly. It shows clients are moving away from ad hoc reports and just embedding NIQ's data right into their daily algorithms.
Right, but, top-line growth is meaningless if it bleeds out before reaching the bottom line.
Oh, totally.
So we have to pivot here from revenue to operational efficiency, because they need to actually convert these subscription dollars into profit.
And they did. I mean, the margin expansion here was incredibly impressive. Adjusted EBITDA grew 21.9% year-over-year to $261.9 million.
Wait, 21.9%?
Yeah, it represents a massive 270 basis point expansion.
Wow.
So that brings their adjusted EBITDA margin to 23.3%.
And you really see that flow down to the cash flow statement. Levered free cash flow inflected positively to $74.1 million for the quarter.
Which is a huge turnaround.
Right. That's a $137.3 million improvement year over year.
Yeah, they stopped burning cash and started stacking it. And that brings us to the balance sheet.
Which has always been their weak spot.
Exactly. But with this new cash flow, net leverage dropped to 3.1x, down from 3.4x in Q1, and management explicitly stated they are on track to finish 2026 below 3x net leverage.
And the rating agencies are noticing, right?
Yeah, S&P Global Ratings literally just upgraded NIQ's credit rating from B to B plus 6.
I got to jump in and question the durability of these margins, though.
Okay, fair.
I mean, when a company suddenly generates $74 million in free cash flow and expands margins by 270 basis points in one quarter, you have to ask, is just one-time aggressive cost cutting?
Like slashing R&D.
Yeah, exactly. Are they just firing people to juice the EBITDA, which is structural leverage that just won't last?
It's a really good question, but the retention numbers actually give us the answer here.
Okay, how so?
Well, they reported 105% intelligence subscription net dollar retention.
Right.
And 99% gross dollar retention.
Oh, wow. Okay, 99% gross retention means practically nobody is churning.
Exactly. The revenue base is incredibly sticky. And that 105% net retention means existing clients are spending 5% more this year than last year.
Just through upselling.
Right.
Yeah.
So the leverage is structural.
So if the margins are expanding structurally, there has to be a catalyst. And management pointed directly to one specific driver for all this efficiency.
AI.
Yep, AI.
CEO Jim Peck spent a lot of time on this. They are using AI-driven productivity initiatives to actively improve their cost structure.
Right, automating the data ingestion.
Exactly. It's carving this realistic path toward management's long-term target of low 30% adjusted EBITDA margins.
Let me use an analogy here because I think it helps visualize it. Think of NIQ's legacy setup like a race car with a really clunky manual transmission.
Okay.
Right? It takes a ton of effort and human capital to shift gears and process all this global retail data.
Yeah, it's manual and slow.
Exactly. But integrating this AI is like swapping that out for a state-of-the-art automatic transmission. It speeds up the data processing internally, which boosts the margins, but it also offers a much smoother ride for the end user.
I like that because it's not just internal cost cutting. AI is actually driving top-line monetization now.
Right.
I mean, BMO Capital specifically highlighted these new charter programs as a source of incremental revenue.
Oh, yeah, the AI-related products.
Yeah, they're layering generative AI tools directly on top of their database, so clients can query things using just natural language.
And clients are clearly loving the smoother ride because NIQ's Net Promoter Score, their NPS, actually rose 7 points to 52 in June.
Hitting a 52 in B2B enterprise software is practically unheard of.
Right. It completely validates the strategy. So, the story sounds almost too perfect.
It really does.
We've got record margins, AI tailwinds, dropping leverage, a 42% stock pop. But as financial analysts, it is time to look under the hood for the warning lights.
Yeah, we have to bring everyone back down to earth here.
Definitely.
Because despite that glowing adjusted EPS of 27 cents, NIQ still reported a GAAP net loss of $30.5 million for the quarter.
Wait, they lost $30 million on a GAAP basis?
Yeah, officially.
So that leaves them with a negative reported net margin of what? Roughly negative 7.8 to negative 8.4%?
Right around there. It's heavily dragged down by amortization from acquisitions and, crucially, their interest expense.
Which perfectly highlights the vulnerability on their balance sheet. Because yes, net leverage dropped to 3.1x, which is great.
Right.
But the debt-to-equity ratio is still elevated at 3.01.
Yeah, it is.
I mean, I have to push back on the bull thesis here. If organic growth slows even slightly, that debt load instantly becomes a suffocating collar on their valuation.
Absolutely. The interest coverage demands perfection from their cash flow.
Which makes this current valuation feel a bit like overvalued territory, doesn't it?
Well, let's look at the target price inversion because this is fascinating. Analysts rush to raise targets, right? BMO went to $20.
Okay.
Needham initiated at $18. Stifel bumped to $17.
Right.
But the street's overall mean target is now sitting at $14.69.
Wow. So the mean target is actually below the post-earnings closing price of 16.58.
Exactly. The stock popped so hard it overshot the consensus intrinsic value.
And the quantitative models agree. Investing Pro currently lists the stock on their most overvalued list.
Which is a huge warning sign for retail investors.
It is. So bringing all this together, the massive numbers, the AI narrative, and these looming debt risks, You have to be really careful here.
You do.
Which brings us to a final forward-looking puzzle to leave you with.
Yeah, this is something Needham analysts pointed out. They suggested that because of this balance sheet progress, NIQ might actually initiate a capital return program like buybacks or dividends within the next few quarters.
Okay, stop right there. Think about that for a second. If a company with a 3.01 debt-to-equity ratio and negative GAAP net income starts aggressively returning capital to shareholders.
It's a huge red flag or a green flag, depending on how you view it.
Exactly. Is that a sign of supreme confidence that their AI is going to generate endless cash flow?
Or is it just a risky financial engineering move to keep this 42% stock pop elevated?
It's a critical tension to watch. How they allocate their next $100 million will tell you everything. So, to stay ahead of moves like that, make sure you follow the deep dive for our daily earnings coverage and financial analysis.